Shares in Telstra suffered their biggest one-day fall in 18 months as investors were spooked by the company's weak outlook. The $3.9 billion profit was in line with expectations, but Chief Executive David Thodey warned that earnings could fall next year by as much as 9% as the company battled to grow market share. Investors were told that the benefits would come in 2012 as the CEO flagged a transition year ahead. Here's Philip Lasker.
New CEO, new vision, but Telstra continues to bleed.
2010 definitely was a tough year.
Net profit was down nearly 5% to $3.88 billion. Sales revenue was down more than 2%, although the deterioration slowed in the second half.
You know, we've seen quite a significant change in consumer behaviour, which we've sort of seen happening for a while, but now has accelerated. And of course, we've seen much tougher price competition.
The deterioration in Telstra's high-margin fixed-line PSTN business is accelerating, with revenue down 8%. Revenue for advertising and directories and other high-margin business was also down. Fixed internet and IP revenue was higher, with the lower margin mobile revenue growing strongly to more than $6 billion, one of the bright spots according to analysts.
Where the growth rate for Telstra was a bit lower in the first half, they picked it up in the second half, so they seem to be perhaps winning back a little bit, or at least slowing the rate of decline in market share.
Market share is now a priority for the new chief.
We have been losing too many customers, and we cannot allow it. In fact, you know, I'm not going to allow it to continue.
The PSTN margin and revenues are dropping faster still than these other products are increasing. So they need to increase that take-up rate on the new side. And to do that, they're going to have to put a bit more money into those products.
David Thodey's war for market share will add about $800 million to costs, so next year becomes a transition year, with investors asked to lower their expectations.
We expect an increase in the customer base with flattish revenues in 2011. Our investments will lead to a high single-digit percentage decline in EBITDA, free cash flow between $4.5 and $5 billion, and from 2012 the benefits of our investments will become obvious.
We can see 2011 a lot more clearly than we can 2012, and we're not yet inclined to give too many people the benefit of the doubt about 2012.
Investors voted with their feet, wiping more than $3 billion off Telstra's value, sending the shares almost 10% lower. The final dividend remains at 14 cents a share, but it was the guidance that really rattled the markets.
At the moment we have a clear strategy, we have clear guidance, so we have clear basis for valuation. The only unknown really is what happens to the dividend over the next 18 months.
I don't believe the board would have ruled off on that strategy and the extra costs going into that strategy if they thought there was a risk to dividends.
And what about that other uncertainty, the national broadband network, which is hostage to the election outcome?
Whatever happens with NBN is irrelevant to what we need to do as a company.
And, according to David Thodey, so is the election result.